Welcome to Talk Tickers. Today, we're digging into the latest quarter from the spice and flavor giant McCormick. Now, they just posted what looks like a classic earnings beat, but the stock turned around and fell almost immediately. So we're going to break down exactly what happened and why.
Right, so this is the central question, isn't it? McCormick's third quarter numbers, on the surface, looked pretty solid. They beat what the analysts were expecting. But the market's reaction? A clear thumbs down. So what exactly did investors see in the report that made them so nervous?
Well, what we're looking at here is a textbook case of what we on Wall Street call a beat but trim. It's a really common scenario. The company, McCormick in this case, does better than expected for the quarter that just ended, but then they turn around and lower their financial forecast for the future. So, simply put, the past looked great, but management is basically waving a little red flag about the road ahead. And to be clear, the quarter was solid. Revenue came in at $1.72 billion, and adjusted earnings per share hit 85 cents. Both of those numbers were a little bit ahead of what Wall Street had penciled in. And what's really important here is that this was their fifth straight quarter of volume-led growth. For a consumer company like McCormick, that's a fantastic sign of underlying health. But all that good news didn't seem to matter one bit to the market. The stock dropped almost 3% right after the announcement. And that's because the reason for the sell-off had nothing to do with the quarter they just reported. It was all about what they said is coming next. And that brings us right to the heart of the matter, the guidance cut. You have to remember, the market is always looking forward. So any hint of trouble on the horizon can completely overshadow strong results from today. So let's unpack exactly what management is signaling for the full year. Okay, here's the problem in black and white. While McCormick kept its sales forecast the same, which is good, they cut their earnings outlook. The adjusted EPS range was brought down by about 3 cents on both ends. Now I know what you're thinking. 3 cents, that doesn't sound like a lot, but in the world of quarterly earnings, that's the headline number that sets the tone, and it was enough to drive this whole negative reaction. So why the cut? Well, it boils down to 3 main pressures. First up, the cost of their raw materials, their commodities, is going up. Second, because of those higher costs, their gross margins are getting squeezed, contracting by about 120 to 130 basis points. That's just a fancy way of saying about 1.2 to 1.3 percentage points. And third, and this is the big one, the impact from tariffs is getting a whole lot worse. Let's really dig into this tariff headwind for a moment, because it is absolutely critical to understanding this story. Management actually spent a good chunk of time on their earnings call trying to explain this new reality to analysts. So for this year alone, the company is now bracing for a gross cost from tariffs of around $70 million. Now that is a huge jump from their old estimate of $50 million. That extra $20 million hit flows directly to the bottom line, and it explains a huge part of why they had to cut their guidance. But here's the thing, this isn't just a 2025 problem. When you look at the long-term annualized hit, their exposure has skyrocketed from $90 million to $140 million. This tells us that tariffs aren't just a temporary headache. They are becoming a major structural cost increase that McCormick is going to have to deal with well into 2026 and probably beyond. Okay, so costs are up, tariffs are a massive headwind. The next logical question has to be, what's the plan? What's management's playbook here? How are they going to fight back and protect their profits? They've laid out a pretty clear 3-part strategy. First, they're going to lean heavily on their internal productivity and cost-saving programs. Second, they're actively trying to find alternative sources for their ingredients and make their supply chain more efficient to try and dodge some of these tariff impacts. And third, they're going to use what they call surgical and selective price increases. And this quote from the CEO, Brendan Foley, really gets to the core of their challenge right now. See, they could just raise prices across the board to cover all these new costs. But if they do that, they risk killing the awesome volume growth momentum they've built up. So it's all about this delicate balance, raising prices just enough in just the right product lines without scaring off their customers. And while they're fighting all these short-term fires, it's worth noting they are still making big moves for the long term. Their plan to up their ownership stake in the McCormick de Mexico joint venture is a huge deal. It gives them much deeper exposure to the really attractive Latin American market, which could be a fantastic growth engine for years to come. So let's put it all together. What is our final take here at Talk Tickers? And what should you, as an investor, be watching for between now and their next earnings report? Okay, here it is. We are assigning a market perform rating on the stock. Look, the performance in Q3 was definitely solid, but these tariff and margin headwinds are creating a ton of uncertainty. The number one thing we'll be watching for in the fourth quarter is any proof at all, that their cost-saving plans are actually starting to work and improve those gross margins. Until we see some real clarity on that front, we expect the stock to pretty much trade sideways, just stuck in a range.
And as always, a reminder that this is not financial advice.